Joining us here at Post 9 is Alexandra Wilson-Elizondo, Goldman Sachs Asset Management, Global Co-Head and CIO of Multi-Asset Solutions. Do you think the bond market is flashing any warning signs?
Good morning. It's nice to see you. We are starting to see bonds rally. We do think that that's a fair rally, especially as a result of some of the data that's been coming through. So there are some cyclical reasons to see the momentum there. That being said, there's still meaningful uncertainty as it relates to inflation, and we do think that yields are going to be capped, but a little bit range bound on both sides, just as a result of some of those dynamics.
Yeah, I sort of set it up this morning because we got that hotter PCE inside the GDP and also higher jobless claims. So a little bit weaker labor data, but hotter inflation. Is that going to be a tougher setup now for the Fed?
I think the Fed, for right reasons, has been sidelined, and it has been an active decision that they've made rather than, passive where we don't know what we're doing. And I think in the next 6 months, you are going to see some softening in the data, in particular from the labor market, which we have seen. When you look at hours weekly worked, there's a lot of capacity there. So the dynamic in terms of the power dynamic between employee and employer has shifted. So you could see some of that labor hoarding start to hit the market. And as a result, it's more of a two-sided dialogue for the Fed rather than just a singular inflation narrative that they're constantly fighting against.
Right. That was sort of what Schmidt said today about monitoring both sides of the risk curve. What are poignant risks when you mention equities? We just showed that on the screen. What does that mean?
So right now, the setup for equities on a short-term basis, it's tricky, in particular in the United States. And that's a result of, having all of these policies that are coming forward that are more restrictive in nature, right? So you're talking about tariffs, which is a tax, talking about, some of the DOGE implications on the marketplace. Then you had very high valuations. You had a lot of momentum in terms of sentiment, in particular in January. So you had, meme stocks, something that looked like what was happening back in 2021. And so from our perspective, there's room for this to continue to go down. But we do ultimately see that the market is going to come up in line with growth expectations, in line with a consumer which is showing anxiety, but ultimately has a lot of dry powder.
Is that why we haven't seen a lot of target revisions for year end or downgrading equities to neutral, anything like that?
Yeah, the ultimate outcome of what we've seen in earnings is that corporates are quite robust, and there's a lot of confidence from CEOs. Some of that has been displayed in the way that they've increased dividends. So we saw two very large retailers increase dividends this last week, and that's their way to signal to the market that we're pretty confident here.
So what looks mispriced to you in this market right now? Is it those cyclical stocks?
So actually, when we look at credit spreads, they're very tight. Now, could they stay tight for quite some time, just given the dynamics of what structurally happened in fixed income? Yes. But the upside downside or the convexity is skewed from our perspective. So it's time to be thoughtful. The balance sheets are good. But if you start to see increased M&A supply, things hitting the market, more individual stories, this is something that we should be a little bit more nuanced on.
Yeah, we had Johnny on, right, earlier in the week talking about spreads, and it's been amazing to watch.
It has
right?
been.
But is the thinking that that can't go on? Or is there any reason why that should be interrupted?
No, it very well can go on. And in fact, when you look at some of the things that drive spreads, so like duration or average maturity, they've come in. So high yield market's the shortest duration that it's been. And so that justifies some of those tight valuations and tight spreads. And shorting that level of carry is very difficult and hard to do. But if we do start to see any sort of gyrations in fundamentals, that's the first place that we would look to lighten up a bit, because you can get the similar yield in the rate market.